name is Max Fonorev. I'm a Chief Fair Value Officer at Sorbus Advisors. Sorbus Advisors is a full-service valuation advisory firm that supports corporate financial reporting, tax compliance, and transaction planning for our clients through providing fair value estimates. My own experience started in mid-90s, actually, in equity research. I joined KPMG in 2005 when I started focusing exclusively on financial reporting and tax compliance issues. Sorbus Advisors was founded in 2008, and in 2010 I joined full-time. So at Sorbus Advisors, we cover valuations of financial instruments naturally. We also do valuation of business interests, as well as intangible assets for tax, as well as purchase price allocation purposes. So in this webinar, we will go over first just kind of talking about financial instruments and the intuition surrounding various attributes of those financial instruments that would lead you to consider some of those more, let's call them more complex methodologies. We'll talk about closed form solutions. We'll talk about binomial method and Monte Carlo method of analysis. These two are workhorses of financial instrument valuations. And then, of course, we'll compare two methods. We'll talk about selecting various methodologies for various types of instruments, kind of briefly run through those examples. And then at the end of the day, at the end of the presentation, we will talk about your process with auditors and potential pitfalls or surprises you might find in this process. So let's first talk about what is financial instrument. And here we can think about kind of holding financial interest in any kind of way. So we can just have cash in the bank or in our pocket. We may own some equity securities, and that could be through your brokerage account of Microsoft or Facebook or what have you. Or you can just have a share of a little enterprise with your college roommates selling T-shirts. Financial instrument issues arise primarily when we deal with contracts. And here I'd like to make that disclaimer that when we talk about when we talk about contracts here, in no way, shape, or form, anything you hear in this presentation should be viewed as legal advice or legal definition of anything, or an accounting advice for that matter. So I'm not an attorney, I'm not a CPA, and we focus at Sorbus entirely on fair value issues. But some of the words or terminology here may resonate with some of the financial reporting concepts or definitions, and so I'd caution here in interpreting anything I say here directly into how you would treat anything in the accounting context. So a contract is essentially any kind of piece of paper that describes a more complex relationship between two parties. So you may have a contract where two parties, one of the parties is contributing cash or maybe another financial instrument, or maybe even intellectual property into the venture in exchange for some later consideration that they receive. And that consideration could also be in the form of cash or financial instrument. And typically, when we talk about those financial instruments, there would be this type of element of the contract that would lead one party of the contract to be forced to transact at unfavorable terms. So, for example, in the simple stock option example, if the stock option is in the money, then you can force another party to sell you the shares at the price, that exercise price that would be below the fair market value of the share. So forcing somebody to act not in their best interest. And of course, that sometimes can go the other way. So Typically, with financial instruments, you can kind of start thinking about using those other valuation methodologies when you see some of the things that are listed here at the bottom of the slide. So for example, the nonlinear payout situation. Again, stock option is one of the examples where you are not really getting paid anything until the stock price reaches that exercise price threshold. The common stock value in a situation where the company is financed with a number of tranches of preferred equity, the common stock in that entity would also exhibit a nonlinear payout relative to the value of the company itself. So the company obviously would have to grow in size to the point where it has to pay off liquidation preferences first. And even after that, depending on the number of tranches or what have you, the common stock will experience different level of dilution depending on the value of the company. Another example would be earnouts in the M&A context. And so if the seller is of a particular company entitled to the earnout arrangement, then those earnouts are also often structured such that the value of that earnout or the additional consideration the seller is going to receive will have sort of a lumpy relationship to the value of the underlying factor, such as, say, EBITDA or revenue or what have you. Now, another thing you want to look out for is embedded derivatives. And again, embedded derivatives, a lot of times it's an accounting term, but every convertible debt essentially implies that it has some kind of embedded option to convert debt into equity of that company. And so, in other words, there is an option for a convertible debt holder or investor to convert if the value of the underlying shares is favorable enough. Again, doesn't mean in the accounting context that every time you have convertible debt, you're going to recognize embedded derivative. That's an accounting determination, not something that you should ask valuation specialist about. It's your technical accounting expert who will help you with that. And then, of course, payouts may depend on physical events. So, and physical sort of, let's call them real world events and not some kind of relation to financial measure. So let's say, successful completion of a clinical trial or, a certain, milestone or, part of the process achieved in developing a software stack for the company, or even the mere fact of raising financing around is something that could be viewed as this physical sort of binary event that will drive the payout amounts. Now, the more interesting one here, it's the last one's called so-called real options. So if you have a lease with your landlord, you may not always think about this as a financial type contract and may not start thinking about financial instrument. But if that landlord gives you the right to renew the lease at the predetermined rate, say 3 years from now, then there is actually an embedded derivative there. So there is a real option for you. You will make a choice 3 years from now whether you want to extend the lease or not, only if it's favorable. So in other words, if the lease rates are high, then you get this economic benefit of being able to get that space for less. And so that's a so-called real option that a lot of times you might want to consider in the strategic context, for example, when you plan around transactions and such. So here I'll start at the bottom of the slide. I mentioned, linear and nonlinear relationship between kind of the payout structure and the underlying security. So on the left-hand side, going back to the T-shirt company example, as an equity owner of that company, you will get, your return will be proportional to the number of T-shirts you'll sell, and so your payout is going to be the same. We're going to set aside the issues of operating leverage and such, but say it's a pretty bare bones operation there. On the other hand, if you're dealing with, for example, that lease agreement on the right-hand side, your lease rates are going to be favorable to you only if they're high enough. and the renewal rate is fixed. So in other words, until you reach a certain point with those lease rates where leases are expensive enough or in line with your current rate, or in line actually with the renewal rate, then is not really providing you any economic benefit, and you can always drop the lease, so your return is going to be zero. But if there is a delta, then there is a value to you as a leasee to that agreement. Now going back to the top of the slide, and not how I plan to go through this, but anyways, so in order to kind of break down the financial instrument for the purposes of trying to understand the valuation of it, the first thing you have to think about is what's the underlying. And so a lot of times you hear this jargon on the calls or in discussions, what's the underlying for this particular instrument? Underlying, of course, means the underlying security. So for the stock option, that would be the share price. For the lease agreement, that would be lease rates, market lease rates. For the common stock in the private company, the total value of that company would be an underlying factor that we consider. Of course, you can think about financial instruments that are tied to interest rates. They could be tied to foreign exchange rates. There is there's probably endless number of situations you can find there where some kind of economic financial factor is driving the payout of a particular contract. So understanding what that underlying is the really first step in understanding the financial instrument. Then, of course, you have to understand the payout formula. Again, in the simple stock option, the payout formula is stock price minus exercise price. But then you can think about any number of ways, or again, endless number of ways, how the value of the underlying may translate in that value that you receive upon exercise of a particular option in that contract. And so going back to the example of the lease agreement, really when you exercise the lease agreement, the economic benefit that you get is really a discounted benefit of those lease rates that you're going to realize going forward. So there could be like a little DCF analysis that would require you to translate the value of their underlying into the economic benefit that you actually receive. Third, of course, you have to understand the decision tree. So you have to understand all the options and all the rights that each one of the parties of the agreement has there. So, it could be a conversion option for in the convertible debt, but it also could be a redemption option for the company that's issuing that debt. So in other words, they can call that debt back if it's favorable for them. Of course, in the real world, we know that it rarely works dollar for dollar, so to speak. And of course, there is friction and cost of each one of those transactions. But in the financial reporting world, we're kind of taking this simplistic approach, saying, hey, if this is 1 penny better, then we're going to do that type of conversion, or we're going to exercise the option. So let's talk about the valuation methodologies. So everything in the world can be valued using 3 approaches. So it's income approach, market approach, and cost approach. Income approach is really the true valuation analysis. So it's sort of this holistic approach where you really look at what kind of future benefits you're going to receive from the particular project or from the particular investment. You lay out the timeline for those benefits. For example, when those positive cash flows is going to occur. And of course, you will look at the risk or probabilities of achieving those particular stages. And so income approach is really something that allows you to do true strategic planning and truly understand what the value of something is and where it's coming from. So it's actually a real valuation. Now, market approach, however prevalent it is really just a benchmarking analysis. And you sort of try not to be a loser in a game of musical chairs here. So essentially, you have a company, uh, and you might find that on the market, people are paying a certain multiple, let's say EBITDA multiple, for the value of the company, or revenue multiple. And so, of course, if everybody, if most of the transactions out there are at 5x EBITDA, you don't want to pay 10x EBITDA, or at least you have to really understand why you're paying 10x EBITDA. But it's really just a benchmarking analysis. You just don't want to be left sort of stranded with some asset that you overpaid for when you could have gotten a better price. But then, of course, we know the markets are, there's a lot of examples where markets are not value things in a sustainable way, and that's where the market approach certainly fails. The cost approach is where you're really just looking at the cost of sum of parts. So what does it take to put something together? And then the value of that is what you attribute to it. The cost approach is typically used in situations where there's not a lot of other financial information available for the particular situation. And so financial instruments, essentially all of them are valued using income approach. So when we talk about the binomial lattice, talking about Monte Carlo simulation, talking about closed form solutions and some of the discount cash flow situations, it is all income-based approach. And so that's where we actually truly looking at the substance of the instrument. We, like I said before, need to understand what are the payouts are, when are they happening, and what are the, let's say, probabilities of getting to that point. So first, let's talk about the closed form solutions here. So closed form solutions is where you can replace the whole model with a form. And so Black-Scholes formula is one obvious and best example here, where we can value stock option with just that. So you don't have to call your you don't have to call your valuation specialist for it. You can just pull it from online or what have you, and or get the spreadsheet from the colleague. It's not the most simple formula to implement, and you probably can't necessarily follow it with a simple calculator, but it is very straightforward. One thing I'd like to mention here, so Black-Scholes formula works for so-called European stock options. So European style stock option is the one where you can only exercise that stock option at the end of the contract. American stock option is the one which you can exercise anytime you want. And so we know in the financial reporting, Black-Scholes formula is used commonly to value employee stock options. In some theoretical sense is not necessarily correct, because for employees can exercise their stock options anytime they want. And so they actually hold American stock option. But the reality of mathematics here, let's put it that way, is such that in the majority of the situations, especially if the companies are not paying any dividends, then the Black-Scholes formula will give you the same answer for European stock option as for American stock option. But just kind of a fun fact that we're not necessarily using the right formula here. Now, there are other situations that could be reduced to a formula. So Asian option, for example. Asian option is just like a regular stock option, except for your payout is the difference between the exercise price and the average share price over the period of the contract. So in the regular stock option is just the end of the contract share price. Here we're looking at the average. And so the Asian option is commonly used in estimating discount for lack of marketability if you ever work with so-called 409A valuations. Now there are barrier options, binary options. Binary option, for example, is the one that pays fixed amount of cash or fixed amount of asset upon the occurrence of a certain event. Forward contracts, they all can be reduced to a simple formula. Again, not simple formula, but simple situation that you can resolve with a this single formula. Now, also here, I'd like to mention situations which are not necessarily complex financial instrument, but also can be contracts that can be valued with the formula. And so a zero coupon bond, or actually any bond with stable or constant coupon could be reduced to a formula. But that would be an income approach. So essentially, we're just discounting future cash flows with certain discount rate. Now, the convertible bond can also be reduced to a formula. So if it's simple enough, you can just dissociate the convertible bond into two components. One of them is this fixed income component, so principal and interest that you're going to get from it, as though you never converted. And then the stock option value of it. So the ability to convert, and you can just use the Black-Scholes formula, which will allow you to capture the benefit associated with potential conversion should the stock price go above the conversion rate embedded in that convertible bond. So all these things here can be dealt with as a formula, and a lot of times those formulas are used as part of sort of a bigger construct that we create to value a particular financial instrument, especially when we consider various scenarios. So let's talk about binomial lattice first. So the binomial lattice is one of those workhorse methodologies that are used in valuing financial instruments. So there are three steps to it. In the first step, we really first deal with the value of the underlying. And we build this big matrix that really accounts for every possible value that this underlying security can achieve. So in this example, we're going to value a simple stock option with, stock price is $5, and then our exercise price is going to be $5. So this is the contract that you have 3 months before it expires, and we take monthly steps in this analysis. So at each step, so after the first month, the stock price can go up to $7 or $3. And then on the second month, it can go $11, $5, or $2. And then at the completion of the contract, you will have $16, $7, $3, or $1.50. So here in theory, we cover the entirety of the universe of what that stock price can achieve throughout the contract and then by the end of the contract. Now, the second step is to convert those values into the payout. So after 3 months, the contract ended. And so you are forced to either exercise or abandon the contract. So if our exercise price is $5, at the end of it, you will be left with either $11, $2, or nothing. And so that's really the value of your stock option at the end of the situation. Now, in the third step, what we're going to do, we're going to use that same binomial lattice that we built for the stock price, and we're going to replace the stock prices with option values. And I'm going to try to annotate here a little bit. But so essentially, this $11 value is going here, and so on. So now this lattice here is the lattice that describes the value of the option, not the value of the stock. And so the process here is to really roll back, or it's also called backwardation, where in the first step, we were moving from left to right. Is it left or yeah? And in the third step, we're going to go from right to left. So we know what the value of the stock option is at the end of the period. It's simply what you're going to get by calculating the value of the payout. Now, to move back one step, what you need to do, you need to take the weighted average of the possibilities that you have at each node here. So, and each one of those scenarios are called nodes. So if you're in the place where your stock price is $11, the value of the stock option at that point in time is going to be the weighted average of these two possibilities that you have for yourself. So it's the weighted average of $11 and $2. And it's also actually discounted with the risk-free rate. So there are kind of these two little calculations you have to do. And so that's how you come up with the value of the option at this node. So again, each one of those things are called nodes. And so you do it for each node. So the $1 here obviously is going to be the weighted average of 250 and 0, and so on. So you roll back using this weighted average and discounted calculation until you get to the point of inception or beginning of the valuation date, where the stock value is going to be $1.50. Now, note here how the stock price is $5, exercise price is $5, but the value of the stock option is $1.50. So a lot of times we hear from our clients this whole kind of notion that they ask us to value something, but then they say, hey, we're not in the money. So the exercise price is a lot higher than the stock price. So the value of this instrument has to be 0 or, let's say, negligible. But here we have to explain that really when you have an option like a stock option, it can never be 0. It can be very small if you're really out of money, but it can never be 0 because there's always this possibility that the stock price is going to go up. Also, if you think from the standpoint of the fair value and how it's defined, the fair value really is, willing buyer, willing seller. If you hold the stock option, are you willing to give it up for nothing if you still have 3 months left on that contract? Of course not, because there's still a possibility and you don't want to lose that possibility. So you're going to have to come up with some kind of calculation that will make it meaningful or financially sound for you to transfer that contract to that other party. And so, of course, there is formulas for all of this. But they are pretty straightforward. And so that's the great thing for clients. That's a great thing when they deal with valuation of financial instruments. They typically don't need to provide that much to the valuation specialist. The valuation specialist does all the work. That is a direct opposite of, for example, purchase price allocation, where you more or less drown in information requests from the valuation specialist. But here, a lot of it is straightforward. So, for example, when you go from $5 here to $7, the amount of how much up you go is described by this number, by this letter. Typically they call it U, but here is the formula. And the formula on the top right, all you need to know is the sigma is the volatility and delta T is 1 month. So you just need to know volatility and for how long. Going down is the same thing, it's just inverted U. So it's straightforward and you can kind of lay it out. Now, going to step 3, that probability that I mentioned for weighted average calculation is similar style formula, except for here you also have to add risk-free rate to that calculation. And so that's it. You don't need to know anything else but the volatility, the term of the loan, how many steps you're going to take, risk-free rate, and then, of course, importantly, you have to know the value of the underlying on the valuation date. And this may or may not be a simple issue. So that's the binomial. Now let's go to the Monte Carlo simulation here. And so the Monte Carlo simulation is, it's very similar and very different in a number of ways. But think about Monte Carlo simulation, almost the same thing as the binomial. In other words, you have to think about the universe of different stock prices, except for the binomial model is just a single model that accounts for all possible scenarios for the stock price. Monte Carlo simulation is a collection of many models, and in this example, I'm just going to say 1,000 models, but each one of those models considers only one possible path that the stock price can take. So in this case, let's sort of launch Monte Carlo simulation. And in the first model, we randomly select that path that the stock price would take through the binomial lattice. But it's singular path. So from 5 to 3 to 5 to 750, we calculate our payout, 250. On the second step, we take that 250 discount risk-free rate over the term of the contract, end up with $2.20. And we record that in our database as a result from the first model. Now we'll launch the second model. So it's the same model, except for the path for the stock price is going to be different. It goes up, then goes down. Let's say it ends up at $3.40. Our payout is 0, and the value of that situation is 0. We record that here as the outcome for the second model. And so we do that, let's say, 1,000 times. We do that 1,000 times, we accumulate 1,000 answers. And we take the average of all those answers, and the average of all those answers is going to be our fair value. So again, the difference is binomial is one model that incorporates all possibilities, the stock price. Monte Carlo simulation is 1,000 models. Each model incorporates only one possibility for the stock price and how it's going to move through the term of the contract. Now, obviously, something like this is typically driven by some kind of computer software, computer code, and we'll talk about it at the next slide here. So let's kind of compare and discuss the binomial and Monte Carlo simulation and which one you're going to choose for which type of situation. So like I said, the binomial model is nature of it is just a static model. It's sort of like an inanimate object, and it just kind of sits there. It's like a rock on the beach. It's always the same size. It's always the same color. Every time you open that Excel spreadsheet, no matter who opens it, it's always going to give you the same answer. Monte Carlo simulation is not a model. It's a process. And in some ways, and I don't want to scare anybody on this webinar, but it's kind of like AI. In other words, you sort of launch the process. Obviously, there are certain parameters that you set around that process, but essentially you send your computer out there to go and experience what is it like to invest in this financial instrument. And so your computer is going to go out and experience that, let's say 1,000 times. They're going to come back and say, hey, you know, I've done it 1,000 times, and it looks like on average, this is what I'm going to get. So this is going to be the value of this particular instrument. And quite honestly, my very armchair understanding of AI, it works exactly the same way. It just collects the answers to all those questions in those big databases and just gives us the average. So when you go to ChatGPT, it's going to answer based on all this accumulated experience that it has out there on the web. Of course, it's a lot more complicated. I'm not going to try to compare Monte Carlo to AI here in terms of complexity, but certainly in terms of the spirit, that's what it is. It's like it's something that was set out there to go and experience the process that we created and tell us what it looks like. Now, in terms of like which model is good for which type of financial instrument. Now, the binomial, if you can visualize back that matrix that we built for the stock price, you'll notice that at each point in time there, at each node, you always know what your possibilities are. So if you're at $5, you know that you can go to either $7 or $3. And that could be, you know, at the beginning of a contract, in the middle of the contract, you know what you faced with. And so this particular setup actually is very useful in building models where you have to make decisions in the middle of the, you know, midstream. So you could be in the middle of your contract and you need to decide whether you want to convert this instrument or not convert the instrument. You always know what your options are on the next step, and you know what you can get today. And so it becomes pretty straightforward to make that decision. Do you want to wait or do you want to exercise your instrument? So for example, with American option, that's exactly the analysis you would do in the perfect world, where each day you would wake up, or each node, you would make that comparison. Is my weighted average of those possibilities going forward better than just intrinsic value of my stock option, i.e. exercising it today? So binomial is very good when you have to make those decisions throughout the course based on the future of the instrument. Monte Carlo simulation, by contrast, actually doesn't tell you where it's going. We know where it's been, i.e. the stock price, but it doesn't really, at each point in time, we still don't know what all the options are. And so, of course, you can apply or create, you know, build Monte Carlo simulation to do something like this, but it's not that straightforward. And so typically, when you have to make those midstream decisions, binomial can be a lot better. Now, where Monte Carlo is great is when you deal with path dependency. So Monte Carlo simulation doesn't know where it's going, but it definitely knows where it's been, again, i.e. the stock price, because you know, we charted it there ourselves. And so when you have situations where the history of the value of the particular instrument is relevant, that's when you can use Monte Carlo simulation. So for example, when you have stock options or performance stock options that would vest based on the average price of the stock over the preceding, say, 10 or 20 years, the Monte Carlo simulation is going to allow you to track that average and make that decision. With binomial, again, if you think about that binomial tree, you know where you are, you know where you're going, but you don't know how you got there. You don't know if the stock price went up or down, or if it went down or up. And so therefore, in binomial, you can't really know what the average of the preceding trading days were. Now, the binomial gives you the singular answer, right? So whatever the model is, whatever, you know, deficiencies or strength of that model is, we always get one single answer, just like any other Excel model. Monte Carlo simulation, you have to run it 1,000 times, and then you take an average of it. So the average of the 1,000 times is always going to be different, because the 1,000 times, each one of the 1,000 times is always going to be random. And that creates, you know, just kind of execution issues sometimes. But also when you value certain instrument that could be sort of the fractional value of the entire instrument, then this kind of wobbly or willy-nilly way of estimating the final value may not be very handy. So if you value embedded derivative, for example, very often you use the so-called with-without method. In other words, you build two models. One model has your instrument with embedded derivative, another one without embedded derivative. And so in binomial, you would get two specific straight answers to each one of them. The difference is going to be the value of that embedded derivative. In Monte Carlo simulation, there is this kind of softness about the value for each one of those scenarios. And if your embedded derivative is a small fraction of that instrument, then your estimate for the difference between two Monte Carlo models can be even softer and a lot more uncertain, and may not actually fit the requirements of financial reporting, where you have to achieve a certain level of precision. Now, Monte Carlo simulation is great at capturing more complex relationships with underlying. So if, for example, you have two underlying instruments that your contract has to reference, then if there is a correlation between those two underlying, let's say, two different stock prices, any correlation of those two different stock prices are a lot better captured with Monte Carlo method. And then, of course, going into Monte Carlo can be used in any kind of model, any kind of Excel model. It may not even be valuation, but you can always build the model and always embed some variability in each one of those parameters, and then see which one of those inputs are more important. So if you are trying to achieve a certain level of free cash flow in your company for, say, be able to pay off a certain amount of debt, then you have to model that free cash flow. And the free cash flow may depend on many factors, from the pricing of your product to operating leverage to what have you. So you can set up that model. And the Monte Carlo simulation is specifically a tornado chart, and the Monte Carlo simulation can illustrate which one of those inputs are more important, i.e., that's where the management has to focus their attention next year. Now, implementation-wise, again, the binomial model, just like binomial model becomes more precise the more steps we take during the course of the contract, Monte Carlo simulation becomes more precise the more iterations we run, and certainly the more steps we take. So our binomial was monthly for a 3-month period of time, just 3 steps. That's at all not enough for financial reporting time purpose, but we might do it, say, weekly or daily. And so we might end up with 90 steps, for example, daily steps, and that would give us a much better answer. Monte Carlo simulation you have to run. And so again, like I said, the more times you run it, the better answer you get. But it grows exponentially with the amount of precision you receive. So your model can run, your simulation can run for 15 minutes, half an hour, sometimes hour, 2 hours took us to get a good enough answer for audit purposes. So even though we might say, oh, just Monte Carlo simulation, but yeah, I mean, you launch it and you go away for a while. So, and then you come back and you find a small typo in your model and you have to run it for another 2 hours. So even though the client deliverable may not sort of scream a lot of hours and a lot of work with the model, but reality sort of drop a tear for all the valuation specialists out there, but the reality of this process can be very time consuming. Finally, the tools you use for a binomial is a straight Excel model, Monte Carlo, or Google Sheets. You can do that too. Or Monte Carlo simulation, you have to deal with software. You can write your own code with VBA Excel or Python, or you can use the off-the-shelf solutions such as Crystal Ball or At Risk, and those things would put a little toolbar in your Excel, and you can work with it that way. So which methods work where best? I'll run through it quickly. Common stock options, you can do closed form solution, you can do binomial. You can do binomial when you have to capture things such as suboptimal exercise. And this is where the publicly traded companies often experience stock optionees exercising before it's financially optimal. And so again, the decision is being made before contract or option is expired, so binomial is being used there. performance stock options, Monte Carlo simulation, because we're tracking the averages there a lot of times. Simple fixed income, we can do discounted cash flow analysis, convertible bond, I mentioned binomial or closed form solutions. Now, a simple agreement for future equity, those things, despite of what Y Combinator might try to tell you, these things neither simple nor they safe. We routinely find investors not really understanding the key terms of those agreements, and certainly valuation analysis can be pretty convoluted. A lot of times we build the scenario analysis, and those scenarios would be, financing, change of control, or dissolution, and each one of those scenarios would be supported by either Monte Carlo simulation or maybe closed form solution or something like that. Embedded derivatives, I mentioned, without method. And earnouts in the context of merger and acquisition transactions. So there is a full cornucopia of how those earnouts can be structured. They can actually have a linear relationship to the underlying metrics, such as EBITDA, or we may have to actually reduce it to closed form solutions, such as when Black-Scholes formula, but of course, the inputs in that Black-Scholes formula might be a little esoteric. A lot of times we use Monte Carlo simulation there because it allows us to model for, any amount of complexity in that agreement. So last slide here. For financial reporting purposes, as a client, you would work with auditors, technical accounting specialists, and valuation specialists. The first step in this process is to really work with technical accounting specialists and to determine what do you actually need to value. So do you need to value the entire instrument, or do you just need to value embedded derivative? This type of decision and conclusion are made by CPAs experienced in this particular field. It's not something that the valuation specialist should be relied upon in making that type of determination. Now, once you know what needs to be valued, then you can go to the valuation specialist, provide them your technical accounting memo, and from there, a specialist can decide or determine what kind of methodology might be used there. The best practice here is to actually take this proposed methodology to the auditors. Auditors commonly have their own valuation teams, and discuss and agree on the methodology and how certain inputs are going to be derived. While this step is no guarantee that the final report will not raise any questions with auditors, it does de-risk that process substantially. And so you definitely want to do that so that at least at the high level, the work is done in the right direction, and then maybe you might tweak some things based on the auditor's final review of the deliverable. Now, the common pitfalls and surprises in this process, I already mentioned, you have to determine what needs to be done before valuation specialist kind of gets down and dirty. We've certainly been in the situations where we suddenly open the updated technical accounting memo and something else needs to be valued there. That changes, that may change the entirety of the model and entirety of the valuation analysis. Many investment contracts may be different within the same financing round. So you had, say, 10 different investors invested in your convertible bond or in your SAFE round, but not all of those contracts may be exactly the same. So we certainly saw the situations where, one or two investors get to convert into preferred stock, whereas the rest of them are getting to convert into common stock. Again, calls for a different model, different complexity. You want to be able to discuss that with auditors ahead of time, or how to treat this type of situation. So when you're providing those agreements to your, friendly neighborhood valuation specialist, so to speak, then you have to provide all of those contracts so that they can review them all for these types of variations. And then the final kind of the most unpleasant surprise in this process here, probably not most unpleasant, but certainly significant, is knowing the value of the underlying. And a lot of times when we value things like SAVEs or convertible bonds or stock options, the underlying value is available. It might be available through just like publicly traded markets, or those 409A valuations may allow you to estimate the value of the security or the total company, whatever you need to use in your model. But for the private companies that don't do those regular valuations, you might have to suddenly come up with the value of the underlying security, and you may just not have it because the company doesn't do regular valuations. We recently had an example where we were requested to value this financial instrument, and the client was very surprised with the scope of work, took several calls with auditors to really convince them that this is what really needs to be done, not just valuing that contract that they had, that itself was pretty complex, but also valuing the company so that we know where and how to launch all those great and fancy methodologies that we have there. So I'll stop here and solicit questions.